Yo, what's up? I'm gonna teach you how to trade stocks today. Maybe I'm gonna try my best here. If you tuned in to the first two videos, you kind of know where we're at right now. If you haven't, I strongly advise you go back, watch the first two on the channel, because today is the first time we're off of the slideshows and the real class begins. We're gonna be actually looking at some stock charts and real trades that I put on towards the end of 2016 and rode into the beginning of 2017, which accounted for a good amount of my gains during that period. So without further ado, let's do it. Now, the first thing I want to say is that what I'm showing you today certainly is the bread and butter of my trading system, my trading edge. It's certainly not the only type of trades that I put on, but I think every good trading system and strategy has a bread and butter, favorite type move, something where the risk and reward is heavily skewed in your favor, and something that you just love trading the most, and that would be these consolidation, volatility, contraction patterns that we talked about at the end of yesterday. And I just want to highlight the fact that when you think about trade, I think a lot of people have a misconception about what successful stock traders actually do and what they are capable of. I feel like a lot of people think, that you could show somebody who makes money in the market any sort of chart and they'll know exactly where any stock is going at any time, right? They're a genius, but that's certainly not how it works at all. A successful strategy involves finding, there's thousands of stocks out there, right? There's thousands of different securities that you can trade. And on any given week or month, I may only be looking at 5 to 10 stocks. So if you show me just a chart of some random stock or security, I can't tell you more than likely where it's going to go. I'm simply looking for potential supply and demand imbalances that I can take advantage of, and that's it. That is my niche, that is my edge, and I stay in it. Because when you think about what trading is probabilistic in many of the same ways that blackjack is. Maybe you'll get this reference. So you think about games or careers that are entirely skill-based versus entirely luck-based. So something that would be 100% skill is like running track, right? There's no luck. If I go out against Usain Bolt running track, he's going to beat me 100 times out of 100. I mean, maybe he trips and falls one time, and that's the only time that I win. That is something that's 100% skill. On the flip side, you got something that's 100% luck. So I'm thinking like the lottery. No matter how many times you win the lottery, some people have won it like 4 or 5 times. Small ones, not like the big ones, I don't think. That's 100% luck. Trading falls somewhere in the middle, and certainly if you're just going out there and buying random stocks, I think it falls more towards the luck side. But if you find an edge, find a niche, I think it falls closer to the skill side. It's very similar to blackjack in the way, if anybody's played blackjack, the way to skew the odds in your favor over the long term is playing by the book, what they call the book, which gives you, just the best percentage chance to beat the dealer over the long run. You got to play by the book. And in these games that are probabilistic, like trading and blackjack, you have to focus on the process as opposed to the outcome. Okay, I had to go use the bathroom. That's why I cut the video. Anyway, blackjack, probabilistic, the way that you skew the odds in your favor in blackjack over the long term is playing by the book, is what they call it. And, according to the cards that you're showing and the cards that the dealer is showing, there's something that you should do each time, and if you do that, if you play by the book, technically the odds are in your favor over the long term. But trading and blackjack are similar in the sense that you have to focus on the process as opposed to the outcome. So if you're playing blackjack, anybody been to the casino, you're showing 17, technically the book says that you should stand, right? The odds are in your favor to stand and beat the dealer. You could hit and win, right? You could draw an ace, a 2, a 3, or 4, hit 21, and cash out. So the outcome was good, but if you continually do that over the long term, you are going to lose money. Trading is the same way. You can take bad risk reward trades, make money on it. It was still a bad trade. And on the flip side, you could hit on 16 or 15 like the book says. You could bust, lose money, but that was still a good decision. Just like in trading, you can put on a good risk-reward trade, lose, and that still be a good trade even though you lost money, because if you do that in the long term and your system is effective, you will make money. So like I said, the main part of my system, spotting volatility, contraction, spotting consolidation, and I'm going to walk you through some real-world examples, real trades that I took. I don't know how to verify it or show them to you exactly, but you could either trust me or not. I don't really care. So here we go. We're looking at a weekly chart of Disney. Here you are looking at about, keep in mind I'm trading on weekly and monthly charts. I don't know what the day-to-day is going to be most of the time. I'm spotting big trends. So just here, you're looking at almost 2 years of price action, and this is what I want to focus on. So volatility, the dumbed down version of it is, how much stocks are moving up and down, right? The price range of a stock. And you can see Disney had pretty high levels of volatility, especially for this stock throughout the early part of 2015. You see down here all the way until we're looking at about October 31st through October of 2016. And this is what you want to look out for. This is Disney trading in a range from about $90 a share to $120 here. And this is the end all be all pattern for my trading system. And I'm going to show you why. What you're looking at here, right? You just drew some lines on a chart. Like I said, most people, technical analysis, going to look at that and be like, what the fuck does that mean? I'm going to tell you what it means. Here with Disney at $90 a share, I don't know who it is. I don't know if it's a hedge fund. I don't know if it's an investment bank, a group of retail traders, an institutional trader. Somebody is buying Disney at $90 a share, right? Price, goes up, whatever, comes back down. Somebody's buying Disney at $90 a share. Goes back up, comes back down, $90 a share. Now, this move here, we'll get into this later. I think I'll make my own video on this. We call this the Daniel LaRusso, the sweep the leg type move. Price broke under $90 a share, ran everybody's stops, ripped back up inside the range. There is an active buyer at $90 a share in Disney. Now, on the flip side, somebody's selling Disney starting at 120, and this seller is aggressive, right? So you got to 120, you came back down to 90, you bounced. Now it only got back up to 106, 107. They said, okay, I'm selling Disney right here. Prices came back down. This time it only bounced to 100. They said, okay, I'm selling Disney here. I'm selling Disney here. And these patterns, buyers and sellers are engaging each other, and it gets to a point where it's so tight. Volatility is so contracted. It is so, you'll hear the term coiled up, that somebody has to win out. It's either the buyer or the seller. And like I said, if you're trading something like a Disney, which obviously is a fundamentally sound company, you can make arguments about cord cutting and, not making money from ESPN. You look at the long-term chart of Disney, you want to see these patterns in the context of an overall uptrend. Disney is an uptrending stock. You look back to 1998, you're going from bottom left to top right. This is an example of a fundamentally sound company that is consolidating and showing a technical pattern that is very predictable. And I'm going to show you why now, because when these consolidation ranges break and the buyer or seller gets exhausted, that is when new trends develop and prices go. This was a move in Disney from 90 to 116. Disney doesn't move a lot. It's not a high beta stock. That's a pretty big move for it. I got in around 92. I didn't even sell the top, so I didn't catch the exact bottom. Didn't catch the exact top. I think I sold it somewhere around 108, 110, something like that. But I caught the bulk of this move, right? That's what I want to catch. And you'll ask, like, when do you want to buy these stocks? You want to buy at support. So at 90, those are what you call a support level, right? Somebody's in there, a buyer is supporting the price of the stock. I always want to enter these trades on the brink of collapse because I want to know very quickly, I want to know very quickly when I'm wrong in this trade. So, like I said, these don't always work out, and I'll give you examples of when they didn't, but had Disney broken down from $90 a share and maybe you got a weekly close at 88, I know this is wrong. This range is broken. At that point, everyone who had bought in this range would now be underwater, which is going to bring a lot of supply to the market. They're all going to be wanting to get out, selling the stock. Nobody's going to be buying because your support just broke down. So I want to be right here where nobody else is except for people buying at support. So that was an example of Disney stock. Now I'm going to show you quite a few more and kind of go more quickly through these just to show you that this is not a fluke, because I noticed multiple charts doing the exact same thing dating back last fall. So here we go. All right, now we're going to be looking at a chart of Apple. Everybody knows Apple. You got your motherfucking iPhone out. Now, Apple was doing pretty much the exact same thing from October 2014 to July of 2016. There's a buyer in Apple right here, around $92 a share, around $90 a share. There's a buyer, there's a buyer, there's a buyer. On the flip side, there's an aggressive seller in Apple. They're selling it, they're selling it, they're selling it, they're selling it until you come to a head. Something happens. Normally, there is a catalyst that will break this range. A lot of the times it is earnings, and that's where you have to be careful, and you have to also understand the fundamental picture of the story. But most of the time, in the context of an uptrend, these are continuation patterns, right? So Apple had been trending and then consolidated, then it trends. This goes into, price acceptance and price discovery. Stocks are always in those two modes. They're either accepting price or they're discovering new prices. Consolidation, volatility contraction, price acceptance. They're all the exact same thing. You can see once the seller in Apple was exhausted, the new trend develops, and Apple just kept on going. I missed a lot of this move, not going to lie. I sold it too early. I bought somewhere around 92, 93 here. Again, so I would know very quickly if you broke down out of this range, I would be wrong. I think I sold right here around 130, 132, and the stock is still trending to this day. I should still own it if I'm being honest, but I wanted to take my profits. I wanted to catch the bulk of this move. I don't necessarily care about being in the entire thing. All right, so that was Apple. Let's look at some more. Now we're looking at a weekly chart of Netflix. So here at Netflix, you're going to notice the exact same thing, almost at the same prices. I don't know. It's just a coincidence that all these were trading around $80, $100 per share, but there is a buyer, a supporter of price in Netflix right here around 85, 80. They bought multiple times, and once again, there's an aggressive seller here along this trend line. Eventually, one of these guys gets exhausted. It just so happens in all of these that it was the seller who ended up losing out. Netflix, once this happens, the new trend develops. It's very predictable. That is the move that you are trying to catch at the end of these consolidation patterns. So that was Netflix. I didn't even get a great price in Netflix. I think there was like an insider that, let's look at the daily chart. There was an insider that bought in here somewhere. I forget where it is, but I obviously wanted to be buying around 85. I ended up catching this one around 92, 93 as well. Sold it on this earnings report. Where am I even looking at? Am I even looking at the right? Yeah, we're looking at the right thing. I sold this earnings. So I sold around 140. It's now trading at 157. Should probably still be in that too, but shit happens. You can't catch the whole move. So we did Disney, we did Apple, we did Netflix. What else did we do? Oh, one of my best trades. Let's look at Tesla. Shit, that's not Tesla. That's Tesla. Okay, so chart of Tesla. And this is one of those situations with Netflix as well, where during this move that nobody saw coming, except for me, the fundamental story of Tesla did not change during all of this, yet the price nearly doubled from where I bought it. So Tesla was trading in a range for years, and the longer these stocks consolidate, the more explosive the moves are. So this one, let's look at Tesla here. Obviously, it's trading in a range from about 180. You got buyers, you got buyers, you got buyers. What the fuck was that? Okay, I don't know what that is. We did the Daniel LaRusso once again. This is the sweep the leg. Should I go into detail about what that is? Like, whenever you get into market, it's not hard to identify support and resistance levels, right? Any trader worth their weight, I mean, even very novice traders are going to be able to see that Tesla has support here at 180. So what happens is you need to start looking at the market as a system that is designed to fuck you over. And if you do that, it'll start to make a lot more sense, because what happened here was everybody had a stop loss at 180, because at 180, you get below that, all these people are underwater, right? And, they ran everybody's stops and they ripped it back up into the range and left without everyone. And I bet you everybody was up here buying at 260. They got stopped out down here. And then they came back and were selling down here. Everybody's selling where you should be buying and buying where you should be selling. We looked at the buyers. Obviously, you have sellers. The top of the range was right around here. So I bought Tesla at 187. Let's move this around. Bought Tesla at 187 down here at the bottom of the range. Sold it too early. I sold it about 285 during this month. And I thought it was a good sell because obviously you got up out of the range and reversed pretty hard on elevated volume. It's a pretty bearish candle, especially on the monthly, but it just kept going. I sold it at 285. It eventually traded all the way up to 327. So a move from 187 to 327 in 6 months that nobody saw coming, while the fundamental story of Tesla, its earnings, its cash flow, actually got worse. And yet no one could figure out why Tesla, rocketed that much. It's because the fucking stock had been consolidating for 3 years. There was like 30% short interest, which also helped fuel it higher. Everybody was shorting, betting against the stock, probably fundamental guys, because it's overvalued. Yeah. How's your trading account look after shorting Tesla because it's overvalued? So that was what was that? Tesla, Disney, Netflix, Apple. What else did I trade? Those were 4 big ones, I think. That might have been it for the consolidation trades. And then I guess we'll look at something like Chipotle. And those stocks, I mean, I guess you could say some of them are tech stocks, but they technically don't have anything to do with each other, right? Yet the price was treated the exact same. Supply and demand, it works, man. And it doesn't matter what type of stock you're looking at, it's treated the same way. So I told you guys Chipotle is one of my biggest positions, and I'll show you a little bit why. And I'll show you 2 stocks here, Chipotle and something else, which had the exact same look to it, 2 completely different companies. So Chipotle, great stock, fundamental story, fantastic. Love eating Chipotle. I fuck up some bowls. But back here in late 2015, they started poisoning people. They started giving people E. coli. The stock sold off, and I didn't touch it on the way down because it was just selling, right? But eventually, you start to form a bottom here, and you start to see another form of consolidation. Now, this also is going to look a little bit different every time. You just want to see where buyers and sellers are both engaging the market, and it's coming to a cusp, right? It's getting so tight. Volatility is so contracted that the price has to go somewhere. So in Chipotle, you had a seller right here around 430, 440. They're selling. And yet you had an aggressive buyer down here. They're buying. And this is where I first started buying Chipotle, was around $400 a share. And we'll talk about how to scale into trades. And this is where, when it breaks, new trends start to develop. Chipotle has been trending for a couple of months now, but I ended up buying a chunk at 400. I bought another chunk right here around 450, and then I bought another one recently around like 483. So I'm a little down on that, on those shares, but that brought my break even somewhere around here at 440. And now my stop is at break even. So I'm never going to lose money on this trade unless it gaps underneath that, because I'm going to get out if you trade back under 440. Maybe it happens, maybe it doesn't. But the key here is that you want to get out of your losing positions quickly and you want to really press your winning positions. When you get a winner, add more. Many people will be they'll be hesitant to let their winners keep going and keep winning, and yet they'll hold on to their losers for a long time. You have to shift that mentality around. You have to keep pressing, keep adding to your winning positions, and get out of your losers quickly. And when I say quickly, again, I'm trading on weekly and monthly charts. Back in 2014, 2015, I must have generated tens of thousands of dollars in commissions to my broker because I was trading so much, right? They send you your packets for taxes, and in those packets, it will detail every single trade that you put on. Back in 2014, 2015, mine was over 500 pages full of transactions because I was trading so often. This year, that might be 50 pages. I might not put on 50 trades. I've maybe put on 20 or 30 this year. So I'm winning, and I'm not generating tons of money in commissions. I am an annoying customer for the broker, right? The broker makes money on the spread, on your commissions, and actually betting against you as well. There's some videos on YouTube that you can look up about OTC gain. The brokers actually have systems in place that will take the exact opposite trade of you if you are a losing trader, and they'll make money because they win, you lose. That's how it works. So I think that's really all I wanted to cover. Like I said, that is the bread and butter of my trading system. Oh shit, let's look at lumber liquidators because it was the exact same pattern. These stocks have nothing to do with each other, and yet you can see here lumber liquidators also, I think, were poisoning people, not with food, but with their lumber. And eventually, it got down. This stock legitimately crashed from 120 down to almost $10 a share. But eventually, this process took over a year to develop, yet you had sellers here. Every time the stock got up, they sold it. Yet there was an aggressive buyer. And once one of these guys went out, not going to lie, if I saw this type of pattern, I might think that in the context of a downtrend, that this is a continuation pattern lower. It ended up working higher. And that's when new trends develop, even when, they must have missed earnings pretty badly here to get this huge gap down. But the stock kept going because there's a ton of demand behind this. The seller was exhausted. And that's where you want to look to capitalize. So that's the pattern that I'm looking for, again, on weekly and monthly charts. And it looks different. Let me show you a couple more just so you really understand. Sometimes you have this downward wedge looking pattern. So something like Freeport McMoran today. This is a stock I'm in right now. I've been in since around 1160, 1150. Obviously, it wasn't the best price. Again, you did the Daniel LaRusso, the sweep the leg. This trend was broken. Came back, ripped right back into the range. Now you're trading at the top of it. What's another one that looks sort of like this? One that actually worked. Let's look at Twitter. Let's look at Twitter stock. I fucked this trade up. I should have made a lot of money on it. Twitter was doing the same thing. Downward wedge pattern, very tight consolidation. Volatility was contracting. And I'll tell you where I messed this trade up. So what I thought was about to happen was this move here. So I took a trade in Twitter because I was like, okay, you got a buyer right here, you got a buyer. I thought what was about to happen was you got this ugly weekly candle, right, that came and just stopped everybody out, and then immediately after you ripped back up into the range. And I thought, okay, this is where stocks fuck everybody over. It's gonna keep going when everybody else got stopped out. So I want to buy here. Unfortunately, I hung on to this trade. I should have stopped out here. I should have stopped out the next week and said, okay, you're still below that support line. There's going to be some overhead supply here. This stock just bled. And, I sort of had some confirmation bias here, and we'll get into some of the fallacies and biases that you'll run into as a trader and how to avoid those. But you had this pattern. It eventually resolved to the upside. I got out for break even in Twitter. I should have held it, and I would have made money, but I fucked that one up. And let me show you before we go. Under Armour here. This is an example of consolidation that doesn't work, and also a good example of why you should get out whenever you're wrong. So I still have these consolidation lines on this chart back from when I was trying to trade it. So here you have an aggressive buyer, an aggressive buyer, an aggressive buyer. You have a seller, you have a seller, you have a seller. Under Armour at the time, I thought, okay, you know, this is in the context of an overall uptrend, obviously, fundamentally sound company. Didn't know retail was going to get demolished. You break down from that range and you just get absolutely destroyed. I believe it was earnings here that finally got this range to break. So that's it. That's pretty much it for consolidation patterns, for the main thing that I'm looking for in stocks, and that is going to give you an idea of how to hopefully how to identify those patterns. Hopefully you can see it. It takes a long time to be able to look at a chart and just notice these things, but eventually you'll be able to just look, no indicators, no nothing. You'll be able to see where your buyers are, where your sellers are, and where that comes to a head. And also, I do my own videos on, you know, entry, exits, you know, where to get into stocks, where to get out. That way you sort of minimize your risk, maximize your reward. But that'll be another video. This was about 25 minutes or something like that. But hopefully it was 25 minutes well spent. Hopefully you understand. If you never looked at a stock chart, you're probably a little confused. That's certainly okay. Over time, it'll make a lot more sense to you. So thank you guys for tuning in to the video. I'm out.